Hello, this is Brad Harvey. Welcome to our Ask the Advisor video series, where we answer your financial questions. Hello, this is Brad Harvey with Ask the Advisor series. Today's question is, what does it mean when the Feds cut interest rates? And in particular, what does it mean when they cut interest rates to near zero? This has happened very, very recently as we started to have a market slide and an economic downturn because of the COVID-19 virus pandemic. The Federal Reserve quickly reacted by cutting interest rates to near zero. Now, why would they do that? Historically speaking, when the government has cut interest rates, because remember, our government can only control very, very short-term interest rates. They really don't have any control over 5, 10, 15, 30-year bonds, and those interest rates, those are set by the markets. But they do have the ability to change the overnight rates. So what banks basically pay for money overnight. And if they take that to zero, that means that the cost of funds for those banks is virtually zero, so they can set their lending rates a little bit lower. Now, the dirty little secret is that typically when interest rates go very low, like they are now, banks actually upgrade their underwriting standards, so it becomes more difficult to get loans. However, having low interest rates overall does tend to stimulate the economy, which can be inflationary down the road, so we want to be cautious of that. But we want to know that having those funds available is to stimulate business, so businesses can go out and borrow money to build plant and equipment or make processes more efficient or other investments in their businesses. They can do that at a lower expense, so that can be very stimulative to the economy. And for consumers, that means you might be able to buy a car and you were borrowing money at a lower rate, or perhaps you were buying a house and you were getting a mortgage at a lower rate. Well, this has the ability for you to either get a bigger house, a better car, or have a little more cash flow left over after you're making those interest payments. So when the economy does recover and things are growing and humming along, then typically they will increase interest rates to make up for it and to kind of moderate that kind of whipsaw that we can have in our GDP growth. So right now they've got their foot on the gas because they want us to come out of this recession quickly and move on to the next phase very smoothly. So this is Brad Harvey with Ask the Advisor series. If you have any questions that you'd like for us to cover on this series, please email us. Thank you. Thanks for visiting our channel. We hope you found the information valuable. If you want to see more videos about investing, please click to subscribe. If you have any questions you'd like for us to answer, send us an email at him@riagroups.com. We would love your feedback.